All right, good morning, everybody, and welcome to the first panel. We might have a small crowd, but I assure you this is probably going to be the best discussion for today. So the panel is the institutional bridge to DeFi, how funds engage with yield, governance, and risk on chain. I'm going to start off with a quick round of introductions, and then we can get right into our conversation. So I'm just going to go down the line here. Charlie?
Great. First of all, thanks for moderating, and thank you to the TIE for hosting us. My name is Charley Cooper. I'm the Chief Operating Officer of Ava Labs. Ava Labs is the software company that stands behind the Avalanche ecosystem. I've been with Ava actually now a little bit over a year and in the COO chair for a little under a year. Our ecosystem is best known for its L1 construct, its L1 blockchain construct, which allows customizable L1s to be built and plugged into us. And we cater to both the retail markets and sort of the most innovative crypto-native, crypto-maximalist communities, as well as to institutional, with a whole host of different technology and product suites, as well as a business team that helps those guys get running and off the ground. So that's me.
Thank you, Charlie. My name is Zhang. I'm the head of US of IntChains groups. So basically, we're an Ethereum debt company. We're one of the first company who put Ethereum on our balance sheet since 2024, and we are second largest Ethereum debt company on 2024. And also, besides that, we're an altcoin mining company. We produce lots of killer products like Dogecoin miner, or Leo miners, and we will continue to use our profits to selling those miners to reserve more Ethereum and support the Ethereum ecosystem. Thank you, guys.
Hey, everyone. Rob Hadick. I'm a general partner at a fund called Dragonfly. We're about $5 billion under management. Been investing in and around the space since 2018. Great to meet everyone.
Hey, everyone. Pascal, President and CEO of 3IQ. We're a global leader in digital asset management. We see ourselves as the bridge, no pun intended, to helping bring more institutional capital into the space. We started with an ETF framework, first globally many years ago, but today our focus is on our managed account platform, really trying to bring sovereign, pension, and multifamily office capital into the space. And DeFi is our sort of our next venture to get into, to bring DeFi capabilities into this, to bring more institutional capital to support the emerging managers that are coming into the space looking to deploy on DeFi.
Great. And just to round it up really quickly, name is Chen, CEO of Function. We are a Bitcoin yield marketplace, 1.5 billion TVL, backed by the likes of Galaxy, Bybit, and Mantle. The first thing I want to call out is just how diverse this crowd is, right? So you got representatives from a major L1 chain, a DAT company, a major VC, and a major asset manager. So the perspectives here can really shape how the different participants in, call it TradFi, look at the DeFi ecosystem. So the first question I want to ask, and the first one's going to be directed to Pascal first, is when institutions think about getting into DeFi, what does that mean? Is it chasing yield? Is it portfolio diversification? Is it trying to control the infrastructure? What is the main motivation behind getting into DeFi?
Sure. So again, the word institution is large and wide, and so everyone will have a different opinion. So when we talk about institutions, it's primarily large allocators. So think about your multifamily offices, not necessarily just servicing crypto, but servicing large wealth, banks, sovereigns, and pensions. So their interest right now, it's still early stage, but is fundamentally, of course, chasing the next generation of alpha, and of course looking for more liquidity. Right now, if you attend large institutional conferences, you'll see the main pain point is liquidity, and the crowded trade in private credit, the crowded trade in private equity, and the lack of liquidity in those funds. They're starting to say what's next, and so DeFi is sort of showcasing that potential promise of either unlocking liquidity on these products if they get tokenized and DeFi has enough liquidity, and or looking for the next generation of yield outside of private credit and private equity.
And as a fast follow-up to that question, where do you draw the boundary on what you define as DeFi? Is it just the majors or some of the alts? Like, where does the line stop from a regulated institution?
They don't know. They just used, right now, their understanding is basically, decentralized finance, and they don't understand exactly what's going on. They'll associate tokenization to that. Necessarily, tokenization can be on DeFi. It could also just be on chain. So they don't fully grasp that. So we're doing a lot of that education for them to understand that you could tokenize and basically go through centralized parties, or you could tokenize and deploy on DeFi and then start accessing more liquidity. So we're doing a lot of work with them. I still say they're a few years away, which we'll talk about in some of the future questions.
I'm going to hop around here. Charley, I'd love to hear as your view as the opposite side of the equation, right? So we've got asset managers on one side and then the major L1s on the other side. Are you seeing that type of conversation, that type of flow coming from institutions? What does that look like when the institutions are getting to DeFi?
It's significantly more complicated and slow than people want to admit. And I think part of the reason for that is if you at their fundamental definitions, TradFi and DeFi are about as far apart as you can imagine in terms of how they're structured and what they're trying to accomplish. And if you look back at the original foundational elements, Bitcoin white paper and the rest, crypto is effectively invented to put the institutions out of business. And over the course of time, there's been a recognition on both sides of that equation that we actually need each other in order to thrive and to get the most out of both of what we have to offer. That's a scene setter. What that means then as the institutions that we're talking to, and we have many institutions that are clients of ours that are already live on us, but not doing nearly as much as we would like to, right? We always want to encourage more and more and more, and we get excited by the little things, is that some of the core problems that institutions still face and some of the core capabilities, risk management, infrastructure pieces, et cetera, that they need to fully adopt DeFi are not yet in place. And that means it's up to companies like us to build that for them. And it's up to the DeFi companies that are trying to get the institutions interested in them to speak to the institutions on their terms. So as opposed to a DeFi protocol coming in and explaining why their business model is so much better and that the institutional play is old and beaten up and all the rest of it, it's learning to talk to them and giving the institutions assurances that while they're doing something incredibly innovative and different and ultimately beneficial for everybody, they understand the pain points along risk management and compliance and infrastructure and operational risk and all these various different things. If a DeFi platform or protocol attempts to make a sale to the institutions by saying, we don't need any of the stuff that you used to do, we're going to completely revolutionize it, you've immediately alienated the client and you've shown that you don't understand their business model. And so I think it's really important when you're asking the question about how these come together, it's really important for both sides to recognize the benefits they bring to each other, but be willing to talk to each other on the other's terms to try to understand how they can work better together. And I think sometimes we talk past each other.
I think that's a recurring theme within DeFi for sure. There's a lot of different things you touched on there, Charley. I want to move on to Roger, and from the perspective of, as an ETH DAT, right? It almost feels like traditional institutions are getting comfortable with DeFi, but through a wrapper, which is effectively a DAT, ironically. From your perspective in running the DAT, what have you seen? Is the institutional appetite right now just primarily converging around DATs as the main vehicle or main mechanism to get exposure, or do you see them asking for more?
Yeah, that's a really good question. So basically, I think when you choose a DAT company, it's not only, like right now, people are choosing based on the market cap, right? Based on the trading volume. But I think in the end, like forward seeing, like we want to choose a DAT company that eventually gives you more Ethereum per share, right? You want to choose a company that gives you like 2 Ethereum after like 5 years instead of give you like just 1.1 Ethereum after 5 years. I think those kind of company ultimately prevail, and DeFi helps a lot of that. So if like a lot of like DAT company recently, they're just doing simply staking that gives you like 3 to 4% annualized yield every single year. But like there are lots of like almost zero risk tricks that you can boost that. For example, we are running a solo validator, right? That gave us a MEV yield of like 1 to 1.5 every year. And also when we purchase the Ethereum, we are selling the puts with the Falcon X. So basically largest OTC desk of like Ethereum purchasing. So every single Ethereum we're purchasing, minus and premium, we are like 2% cheaper than anybody else, and plus those MEV yield, the native yield we are getting for pure Ethereum is around like 6 to 7% every single year. It's almost twice than you only do simple staking, right? And not to mention, this is only the beta. There's a lot of alpha on the DeFi as well. And I don't know if you guys know that, but back in 2023 to 2024, there's a platform called EigenLayer. One of the largest like Ethereum holders I know get 25% more Ethereum just by single years, by staking on the Eigen layer. They get lots of Eigen airdrop. They get lots of like AVS token airdrop as well. And lots of those AVS projects eventually get listed on Binance and Coinbase. And they have a huge profit selling all those tokens and purchasing back even more Ethereum. And that basically, if you trust Eigen layers like security, like it's almost like a zero risk like strategy. You can get like 25% of like Ethereum just by 1 year. And not to mention just 2 years before that, we have DeFi summer, right? So I think every 2 or 3 years, there's a huge opportunity for like an Ethereum holder to get like 20 to 30% Ethereum by a single year. And forward looking, like every 5 years, like after 5 years, I definitely think some company will twice the Ethereum amount. There's a company that is large and lazy and doing nothing by just holding the Ethereum, right? So I think DeFi gonna help a lot, and DeFi gonna ultimately provide this kind of opportunity in this industry, and people who chase it will get rewarded. Yeah.
So there's no doubt that there's an incentives-driven market within DeFi and TradFi. You touched on the MNAV, right, for a DAT company and what's important there on a price per share basis. I'd love to turn over to Rob. From your macro viewpoint and also being in the trenches, how are the incentives changing, right? The dynamic between TradFi and as well as DeFi. Do you see TradFi starting to dip their toes more into more DeFi native trades?
I think it kind of depends on what we're talking about, right? So a lot of the conversation to date around institutions being involved on chain has really been about like asset issuers saying like, is there somebody new who will buy my asset, right? Like, am I Apollo and I can do this thing with ACRED, which is their private credit fund? And is there somebody where there's already capital on chain, a foundation, somebody like that who will buy this, right? I mean, Janice Henderson did this CLO product. It's got $1 billion outstanding. The buyer is just Sky, and Sky is essentially just backing their their stable coin, right, with it. That's a sort of an uninteresting thing to me, right, as a venture capitalist, because it's just an asset issuer figuring out if there's some new market that it can tap. We've started to see a little bit of changes or a little bit of experimentation around, okay, well, now I have this asset, but can I do some sort of like novel net new trade that I couldn't do otherwise, right? So like with Apollo ACRED, theoretically, not theoretically, you can actually, through securitize, go and lever it up, sort of like you can loop it, as we call, on Morpho 5 times. It gives you like, it's essentially net 3x leverage. It goes from an 8% yielding asset to a 19% yielded asset with like, Apollo underlying private credit fund. Like that's a net new thing, and the minimum in that is 10K. That's a net new thing that you couldn't have done like through JP Morgan. It would have taken 7 weeks, and you would have had 15 committees who would have told you like there's no reason we should lever up this private credit fund, right? And so I think what we're starting to see is people say, okay, well, is there things that I can do programmatically that I can do on call it a shared ledger that coordinates trust across different counterparties and can get like yield in like real time versus like having to worry about like weekly settlement with the bank or something like that. And is that a product that I can then offer to the end customer? We're really, really early in that, right? And I'd be shocked if we had that type of like net new novel product being offered anytime to, in real size to real customers in the next couple of years. But there's a lot of work happening around it, and there is a lot of infrastructure being built around it. The DTCC actively looking about how they can do tokenized settlement for tokenized assets, especially around private credit or private equity. Right now, you have a lot of people thinking through at the large trading firms, like, what do I need in my back office software systems to be able to do repo and things like that with the banks. And so as you get these types of customers starting to build with certain types of tokenized assets, and by the way, stablecoins are just a tokenized asset, it becomes more of a snowball, right? And so it's like slow and slow and slow, and then it's a lot bigger than you realize. But I think we're still very far away from there being, there might be tokenized assets, but that's very different than people actually participating in DeFi.
Absolutely. This is not even a hot take, but I think a lot of the game right now is just printing TVL and putting it on RWA.xyz. But that's just the incentives that we have today, right?
Well, I mean, look at, like, if you go on RWA.xyz, like, and you look at the assets there, most of it is Figure, right? And figure, great business, $9 billion public company, HELOC business. There's not really anything that exists on chain, to be honest, right? So like they're posting some data like every once in a while and saying, hey, we have all these HELOCs, and yeah, they're getting rid of some of the servicing and origination fees, and it's like they've done. Mike's a fantastic entrepreneur and he's done a great job with that business, but nobody's looking at that and being like, oh yeah, there's like DeFi happening here, or there's like real like activity happening on chain here.
So I want to extend that question to Pascal next. So from your perspective, what is that unlock that needs to happen for you to start allocating? Let's get specific, right? If you're in the investment committee and someone comes to you and says, hey, we actually want to start making this up, looping, probably not. But if they did, what are the actual items in a checklist if that's the way that you evaluate?
Yeah, so I'll take things a little backwards so you could understand how far we are, but it's going to get to where we all believe it's going. I believe that's where people are that's where the puck is going. Sorry, I'm Canadian. But fundamentally, if we talk to a lot of these large players, and what the ETFs did, for example, what IBIT did is it created an investment-only decision and not a compliance decision as well. For example, Mubadala, we have a presence in the Middle East. We talked to all the sovereigns. Mubadala was interested in Bitcoin for quite some time as an asset to add to their portfolio. But then there was a discussion of like how we get a custody, who are the counterparties, how is this going to work, et cetera, et cetera. The investment committee had already said we want to allocate. The ETF removed the compliance and operational risk in their mind. Now, we could still say there's counterparty risk, but for them, they were comfortable with it, so it became an investment decision. I share this because these are all the gates, and things that could go, like people that could say no to all of this. So what's happening now in DeFi and even on the crypto hedge fund space is everyone starts with returns, saying, here's what you can do, here's the yield, it's risk-free. These are all words that we can believe because we understand the technology. They believe it's a sales pitch, right? So you got to work your way backwards. So fundamentally, you got to go into legacy vehicles in our mind that they understand, with legacy means of diligencing counterparties, diligencing the managers. They want to know who's responsible if something happens. And then at the very end, it's how do I make money on this? Because I trust you, I trust your counterparties, and I know a vehicle that I could write a check into that will meet my bankers, my compliance officer, and legal officer sort of checklist. That's what we're trying to build, but it's legacy ways of thinking, bringing money into the modern age. So then the technology can scale, and then you can get vaults and those things like that. But until then, the capital's not going to come in.
I think these are great points, Pascal. I would add that there seems to be two realities happening, right? Because there's the monolithic called traditional institutions that come in over time when the right rails are built. And then there is the very fast digital twins that are born from people in DeFi operating because we have an attention span of a goldfish, right? So I wonder, as a question for Charley, like on Avalanche, as one of the, in my mind, the OG, call it chains that's pushing securitization and security tokens back when it was called security tokens, right? Are you seeing two representations? It's specifically, I think the holy grail is for companies to issue natively on a chain. And yet I'm sure there are other companies, startups, that are doing digital twins because it's composable, it's permissionless, right? Do you see that being a fragmented liquidity issue? How did you see those two worlds coexisting?
Okay, a lot to unpack. Is liquidity fragmented? Yes. Will it stay that way? No. But it will take time for those things to come together. And I don't know that I would put it in as stark a terms between the big monolithic institutions and these mirror image DeFi attempts. I view the world as a spectrum, and I think over the course of time, as we on the DeFi, I'm talking about as opposed to the institutional side, as we mature as an industry, you're going to see everything from the most extreme, radical, innovative, small mom and pop idea to something much more akin but tangential to an institution. And there will be this spectrum in terms of how they approach things and how they develop things. One of the interesting things, actually Rob could talk about this ad nauseum. He's probably seen the best and the worst ideas ever to come across because everybody wants Dragonfly to back them. And I can only imagine that the types of pitches that any institution like Dragonfly sees go from very well thoughtful, established, somewhat larger, close to institutional but not quite ideas to the absolute other end of the spectrum. And I don't believe that what you're going to see is these two worlds existing, institutional and DeFi, in separate worlds in perpetuity, if only because if we don't figure out how to work together and we create this, if we continue to build this sort of fractionalized world, I don't know that DeFi wins that. I think crypto keeps reinventing itself, the different things and the cool things it can do, and the institutions keep trudging along, and the predictions that they would be put to bed a lot sooner than we've been able to do so, I think is evidence of the fact that the onus is still on our side of the ledger to convince the rest of the world that what we're doing that is new, innovative, and exciting is also thoughtful, meets the various different risk parameters, can give investors a confidence that what they're getting involved in is worth getting involved in. So it's up to us to help build the bridge on the sign here between institutional and DeFi. I think we've got to make more of an effort to get to the institutions to convince them that we're solving problems for them and solving problems for their investors rather than just telling them we've got a better way to do this 100%. Than you do.
I want to talk about something you said there. When you talked about a little bit about digital twins versus like primary issuance, right? I'm a firm believer that like the digital twin, I mean, it's useless, right? So like there's a lot of different types of assets are wrappers and they exist in wrappers context, right? An ETF is essentially just a wrapper, right? But when I start to think about, okay, like what is actually happening on chain? Like how do I get like real interest, real liquidity, and net new novel products? I do not think DeFi is going to win because I'm going to take a current product that already exists, and I'm going to be able to use, a Chaos Labs Oracle or a, Gauntlet Curator and a Morpho and like, do something programmatically. It's only going to win if it's like a net new novel yield, net new novel product, net new novel derivative, right? Because like that is something that like then people will understand. Now I can do something that is differentiated versus and offer something that's differentiated, and it can drive revenue to my business, it can drive returns to my business, right? And so when you look at these, like, I mean, the easiest thing to talk about is the tokenized equity space, right? Like, what is happening in tokenized equities today? Well, Robinhood announces they're going to do tokenized equities. Well, what is it really? Well, their U.S. broker-dealer buys an equity, and then like their EU sub goes and like sells you a derivative off of that U.S. broker-dealer backing, and you have no rights whatsoever, and like theoretically that derivative does not have to trade or should not trade anywhere in parity with like this thing that exists in this other area. And it's the same thing that's happening with X stocks, which is even kind of more fucked up. And so like there's a lot of these products that exist to like narratively say we're doing this thing on chain, but that actually have no real utility for an institution, right? And I think that's the problem right now.
Well, so I'm in agreement with all this, but again, these firms and these institutions have to tippy-toe their way in, and bridging the language is important to get there. So I'm totally in agreement with your vision, but you can't go from here to here without the middle.
Yeah.
And you have to build the middle for them to get educated, to build test cases, because at some point, the younger generation who gets this are going to become the decision makers that unlocks the capital. The technology which works today will be integrated seamlessly in user interfaces where the eyeballs are and you can access, and that all of a sudden unlocks liquidity. Until then, I mean, we're just building a vision. That's all we're doing.
Yeah. A couple keywords you gentlemen have pointed out, which is access, right? I think it's a world of competing narratives. And right now for TradFi in front of them, they have primarily access points in ETFs or DATs. So I want to have one last question to Roger before I ask the last question to round out this panel here. As one of the large ETH DATs, how do you think about differentiating the DAT from a narrative perspective against ETFs or other DATs? Are you guys doing anything novel? Looking to any DeFi things to fuel the narrative to stand out against like the Bitminers and the Sharplinks of the world?
Yeah, I mean, like I mentioned before, right? There's a lot of DeFi practice we're using right now. We're working with Falcon X to sell like puts. Like it's not actually like exactly DeFi, but you get like 2% discount on every Ethereum you purchase it. But like beside that, we are looking for some huge opportunity, like EigenLayer level opportunity and DeFi Summer level opportunity as well. We believe that happens every 1 or 2 years, and the next generation gonna come, right? And also besides that, the main focus of our company is also invest in the Ethereum ecosystem, the Ethereum beta. So we're producing ASIC machines that's gonna generate ZK proofs like 30 to 40 times more efficient than the fastest GPU, like 5090s, right? So we're, compared to other Ethereum company, like that company, some of them are just like kids company or pharmacy company that's trying to join this space. We have been in this space for 7 years. And basically we produce miners that can get discount coins from like from the ecosystem. We can generate like the ZK-backed coins, like 30% or 40% of the cost of you purchase on the secondary market and on the Binance. And all the profits are generated by like holding the miners and producing a coin ourselves or selling the miners for profits. We're gonna get reserved more Ethereum. We're a company that can create blood instead of like raising money for purchasing Ethereum, and that's I think it's the main difference that we different from other Ethereum DAC company. So we not only we are very crypto diligent, like we have been fighting on Chen for like 7-8 years. We know the opportunity when the opportunity comes, but also we are constantly every single quarter we're getting profits from selling our products. And by using the product itself, we can get tokens at a discount for the Ethereum beta, the ZKs, right? So all the ZKPs generated, the tokens we have will be much less than you can purchase from a secondary market. And I think that's our strategy. Not only to reserve more Ethereum, but use more ways to reserve Ethereum at a discount. Yeah.
That makes sense. Full stack, be the producer and the distributor. All right, lightning round, 1 minute left. The question is, I'm not going to ask you to predict the price of BTC or ETH, but I am curious, by the end of next year, taking a standard portfolio allocation, what percentage of a standard institutional portfolio allocation will be actively deployed on chain?
Are we going down the line?
Yes.
A fraction, less than 1%.
Less than 1%.
Yeah, I don't think it's going to be anything more than that.
Yeah, I think I will agree with Charlie. But like, I would do a Ethereum price prediction though. Yeah, I think Ethereum gonna hit $10,000 by the end of next year. Yeah, that's why we purchase a lot, right?
You mean traditional asset managers?
Traditional asset managers, yes.
Yeah, I mean it's like zero essentially, right? I mean, not to belabor the point, but like we're a long way away from traditional asset managers like deploying and actively managing on chain, issuing assets, absolutely, right? But like not actively managing.
If I can further that, do you think this will be like a 2018 3-year time horizon or like a 5-year time horizon?
I think we're like a 5-year time horizon, right? And I think you need clarity, right? And it looks like clarity might, or some version of a market structure bill might actually die, unfortunately. I mean, we saw the version from the Ag Committee a couple days ago, but it's unclear if that's going to get passed. And so I think we're still a far away from that. But I do think assets are going to be tokenized, and they're going to just fit within something that the DTCC puts together probably in the near term. Getting a lot of people to actively manage on chain, like it's slow.
Yeah, I mean, nothing much more to add besides like let's just look at where we are. They're starting to deploy to the ETFs, good or bad, right? We just personally secured the first sovereign into the active management side, which is a big win. Some of the banks are going to get activated on the active side and some on the ETF. So to go natively on chain where it's going to be zero next year, we got to talk about 5 to 10 years.
Great. Thank you for your insights, everybody.
It's a depressing way to start the day.
Thank you.
Guys.